As UK companies increasingly look to de-risk their pension schemes, we are seeing increased interest and demand for buy-ins. However, despite their popularity, certain myths do remain which can put pension schemes off from going down this route. Joining me in the studio today to talk about some of these myths and the truths behind them are Pension Insurance Corporation's Tristan Walker-Buckton and Matt Barnes. Welcome to you both.
Thank you. Morning.
Matt, if we just put the first kind of question to you, why would any trustee want to de-risk the pension scheme with a buy-in when that means locking into historically low interest rates?
Sure, this is certainly something we've heard before. I suppose there's two parts to the question. First of all, whether rates are low, and secondly, whether to lock in. So in my career since 1997, every year I've been told rates are historically low, annuity prices are very high, and every year they've got the prices have gone up and yields have gone down. And gilt yields are still at sort of 3% or so there's still room for them to drop. We mustn't anchor our thoughts on the fact that base rates are low. But also, most pension funds in the UK hold some matching assets, perhaps government bonds, gilts, or other types of bonds, and therefore those assets are already locked into the current yields, and perhaps have benefited from the rise of those types of assets. And so where schemes are doing buy-ins, they're often using those assets and swapping them for annuities, much more like for like, and therefore they're perhaps indifferent to the current level of yields.
Great. Tristan, if I can just bring you in at this point, is it not difficult for trustees to justify using a buy-in to ensure maybe like just pensioners in payment, for instance?
What's on the basis that they might feel that they're discriminating against one membership than another? Well, it's important to remember that when the insurance is structured as a buy-in, it's an investment like any other. And so in the same way that trustees might say, this is what I think my cash flow requirements are going to be in year 10, I'll secure that with a gilt. It's just using this insurance as an investment instrument. So although that investment is pegged to certain lives, say the pensioners, that's actually purely notional. It's just trying to get a better match and bringing in longevity risk cover as well. So those members won't necessarily see any difference at all. They shouldn't. The pensions will continue to be paid by the trustees. You can't say that Mr. Smith's pension is any more secure than Mrs. Jones. In particular, if the worst happens and maybe the scheme sponsor gets into financial difficulties, the scheme ends up winding up on an insolvent basis, it's a standard feature of all buy-in contracts that the buy-in insurance can be restructured to cover a different group of members. So you can move from covering just the pensioners to having a lower level insurance, but covering all the members of the scheme, so everybody benefits equally from that.
Thank you. If I can just bring you on to the all-important issue of data, and this is an issue that comes up again and again when you're talking about buy-ins. Do many schemes struggle with having data that's maybe out of date or has gaps in it? I mean, this obviously makes it more difficult for insurers to calculate the premium, doesn't it?
I mean, it can do, but that doesn't necessarily mean that trustees aren't getting the best price if they only have out-of-date data to hand. There are different viewpoints on this, and certainly I think if you're not quite at the point where you're ready to be able to do a buy-in, or it's not something that's quite affordable for the scheme at the moment, then it certainly makes sense to make use of the time available to clean your data, get into better shape. But if it's on your immediate radar, again, a buy-in doesn't have to exactly match the benefits of the scheme. It can match whatever you like. It's a notional instrument. And there are some buy-ins where trustees have deliberately actually ensured slightly different benefits or data than what the scheme actually provides. So, I would advise trustees to, if there's an opportunity there, they can insure on the basis of the data they've got. Maybe it's slightly quick and dirty, but they can capture that market opportunity, and then later on they can true up that data, correct that data. You can often find that in the 6 weeks, 8 weeks it takes you to go away and clean your data, which is actually perhaps only adjusting the liabilities by a small, a percent or a fraction of a percent. You can find that market movements can be a lot greater, and an opportunity which you're identified can move away from you.
Okay. Great.
We've typically found that data can be plus or minus 0.5%, but we all know that markets can move by whole percents, perhaps 5s and 10%. So in terms of which is your biggest risk, you've got to think about market timing before data.
Great. I think one of the big changes we've seen in the market, particularly over the last 12 months, has been the growth in the medically underwritten part of the market. Now, is it worth gathering data on the health status of members as well? If insurers can kind of medically underwrite some of the liabilities, then will trustees get a cheaper premium?
I think clearly if you have a very concentrated scheme with one or more individuals who form a large part of the liability, then how that individual or individuals are rated will be very material to the price. And if that individual was in poor health, then that would bring the price down. But equally, if they're in very good health, it would push it up. And if you consider that insurers look at data from all pension funds in setting their assumptions, then if there's one scheme that gets a cheaper price, there must be another, by definition, that gets a more expensive price. It's a zero-sum game. So you can see how certain schemes might be attracted to it. But it's potentially dangerous because perhaps a scheme thinks they're perhaps more industrial and therefore they'll have perhaps weaker longevity. But actually that would also have been recognised by any insurer anyway, because we use the postcodes, the pension amounts, the industry background already. So a scheme would have to be very, very confident that they were actually had worse health than we would have already anticipated. And trustees generally don't know that in advance. And I think by going down the line of collecting that data, they're opening themselves out to two possible outcomes, only one of which would be attractive to them.
Okay. And if we just kind of move on to kind of, after a buy-in, then what? Are the concerns there that, obviously the remaining liabilities haven't been insured, are they not covered by very risky investment portfolio, given that the gilts have been used for the buy-in? I mean, is that not a bit imprudent, and does it make trustees nervous?
We have certainly seen trustees nervous over this issue. If we imagine that a scheme's got 50% equities and 50% gilts, and then uses those gilts to buy annuities, they then put their pensioners and those annuities out of mind because they think, I've sorted those out. But actually they're still part of the scheme. The annuities are a scheme asset and the pensioners are pension liabilities. The scheme is still a 50-50 split. It's now 50% equities, 50% annuities. And in fact it's de-risked because the annuities are slightly safer than the gilts were because they give a more precise match and the longevity protection. So all in all, that shouldn't cause the trustees any discomfort. The buy-in is a de-risking measure.
Okay. Tristan, did you want to add anything to that at all?
No, only that once the trustees have done one buy-in, they might want to, it's not necessarily that's the end for them. They might want to keep monitoring the market, and at some point they've already insured the pensioners, but they'll continue to get new pensioners. The deferred members will retire. So it's good to periodically come back to the consideration and think, okay, do I have additional liabilities now that I can continue to insure and do various tranches of buy-in?
Great. So we've come to the end of today's Buy-In Mythbuster. I'd like to take the opportunity to thank the participants today, Pension Insurance Corporation's Tristan Walker-Buckton and Matt Barnes, and thank you all for watching.